Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, I have put a really crazy title here. 20% yield for the next 77 days via what is called convertible arbitrage. And this is a deal that is happening right now. Buyer beware, buy, sell, or hold at your own risk. All right. So, what is it that we are talking about today? The first thing I want to remind you is that I am not a wealth management advisor. I am not pitching anything. This is not politics. I'm merely giving you education. You are going to make your own decisions. Here's how we're going to approach this potential transaction. First, we're going to review again in very short order what a convertible preferred stock is, and then talk about what is the arbitrage. We covered this in great detail in a past episode, so we're going to kind of link to that so you can go watch that to refresh your memory. And then we are going to review a convertible preferred that is maturing in 77 days and what is going on there. And then come full circle back and talk about a good plan for the next 77 days. All right, what is the convertible arbitrage? To truly dive deeper, you should go back to the playlist, and I've put a link to the playlist right here. You can see it. And it is organized numerically. And go to video 33. And that will walk through in 16 minutes what we are going to brush by in this episode in a couple of minutes. So make sure you see that if that term is new to you. Having said that, we are going to look at a deal going on right now. And before we do that, let's review what the convertible preferred is. Again, episodes 32, 33 go into this in much, much greater detail. We looked at an instrument called Roll or Roll Bearing Corporation, RBC, about 8, 9 months ago, something like that. And they had a preferred stock called RBCP or Roll P. And we started understanding how it works. And a convertible preferred is both a stock and a bond. And so it works like a bond, it gives you a coupon, and when it matures, it converts into stock. And it has a par value, kind of like a bond, $50, $25, something like that. I'm going to kind of leave it at this high level. If you want to dive deeper, please go back to episode 32, 33, somewhere around there, and you can see what is going on. I will post a link to the convertible preferred episode right here, and you can go there as well. All right. How does the preferred work underneath the covers? Let's have a very quick overview. Assume that there is an underlying equity. We're going to call the equity XYZ, and it trades at $50 a share. And it has a preferred, and the preferred is called XYZP. And that also trades at $50 par value. We're just keeping things very simple. And it has a 2-year maturity, and it pays 5% quarterly. So far, so good. Here is the date of issue, and here is the date of maturity. And the preferred will usually say we got an upper band and the lower band. And as long as the stock trades between the upper and the lower band, then the preferred will convert into equity pro rata. Meaning, if you bought it at $50 and the stock was at $50 and the stock appreciates 10% and becomes 55, then the preferred will convert at a ratio of 50 divided by 55, and that is why you really gain nothing, lose nothing except the coupon. And it is almost as though you bought the stock 2 years ago, made the 5% return, gave up your voting rights, and converted at a slight discount because you got the coupon value and you got the stock. You got to own the stock at 50 divided by 55 times 55, which is really why it is called pro rata at the end of 2 years. Again, I'm going reasonably fast. We covered this in great detail in an earlier episode. Now, as long as the stock trades within bounds, so we're going to use that same example, date of issue, date of maturity, and we're going to say in 2 years, the stock converted and the stock price was 55. Well, 0.91 times 55 is really $50. You paid $50 for the stock, and that is why you really didn't make any money on the preferred in terms of appreciation or conversion. However, you did make the 5% coupon for 2 years, and that is the math. So when things are within bounds, you make just the bond or just the preferred coupon value and you convert at par. All right, so now let's look at a theoretical example of what happens when you go slightly above or slightly below par. And here things get interesting. So let's say that XYZ is the underlying equity and XYZP is the preferred. What you're going to see in theory, and this is not a real example, is as long as the stock is trading within the upper and lower bound of the preferred boundary, the preferred is kind of sort of also going to follow. It's not going to be perfect, but in theory, this is what you would expect in a well-behaved market where the preferred kind of follows the underlying equity, except reality is not the same. When things go out of bounds, strange things happen. So let's look at another example. Here we have still the same bounds of 40 and 60. Within that bound, things are going to convert pro rata, except if the stock goes above 60. You would expect, if it is pro rata, it would convert at 50 over 60, which is 0.83, except the equity is going to say, wait a second, I'm not going to give away the upside to you. You didn't want to own the equity. You wanted the return on the preferred. So I'm going to give you a lower preference. So the preference, again, it's hypothetical. The preference would be lower than exact par value. So the preference may be 0.75 instead of 0.83. The other side is also true. If at the end, if at maturity, the stock, the underlying stock trades below 40, then the underlying equity says, thank you so much for owning our preferred stock. You gave up your voting rights. That's very nice of you. Unfortunately for you, our stock crashed from 50 bucks to 40 bucks. And instead of giving you pro rata, which in this case would have been 40 over or 50 over 40, which is 1.25, we're going to be nice. We're going to give you 1.3 instead of 1.25. Again, this is the hypothetical example, and you can dive into much greater detail on this in the prior episodes. So the point here is preference is lower when it goes above the upper bound, and preference is higher when it goes below the lower bound. And so that is where the arbitrage is hidden. So what is the arbitrage? The arbitrage happens when the preferred equity does not behave like the underlying equity. And it's a little disjointed. And as you can imagine, if the underlying equity is trading within the upper and lower bounds, it almost doesn't matter what the preferred equity is, for the simple reason that when it converts, it's going to convert at par, ho hum, it will correct itself sooner or later. However, here is when the arbitrage happens. Let's say that we look at the same equity. There is the date of equity, the date of issue, and the date of maturity. Same $40 and $60. And if you go above the upper bound, preference decreases. Below the lower bound, preference increases. And the stock does one of these as it comes towards maturity. There is a big crash, and the preferred, however, doesn't crash as quickly, or it crashes out of sync. Now, all of a sudden, you have an arbitrage. What we are going to do is analyze that twilight zone. The twilight zone where the underlying equity just goes below the lower threshold, creating a big arbitrage opportunity here where the preference goes from pro rata to something above pro rata and creating an opportunity for you. That is where the arbitrage is, and we're going to review an example from the past and look at the deal that is going on right now. The one in the past, we dive into great detail in a prior episode. Please watch that. Effectively, what we show in the case of Roll Bearing Company is the underlying equity, when it traded at 226, the conversion ratio was 0.44. And when it trades at 185, the conversion ratio was 0.54. And therefore, you would pay a nominal amount, either 99, 100, below 100, and there was an arbitrage opportunity there. And we showed that when the stock came towards maturity, when the time approached maturity, there indeed was a big slide in the price. And if you bought it at the right time, you stood to gain 5% in arbitrage, plus 5% in coupon for a total of 10%. But if you bought it at the wrong time, then you lost 10%. Lucky for the world, this particular equity did trade at a beautiful arbitrage opportunity. So if you bought in July, for example, you got 5, 6, 7% right there. And if you rode it out until the end, you kept your arbitrage opportunity and you made the coupon rate. What I mean by that is if you bought it in October, you made just the coupon. You did not make any additional premium. If you bought it on July, you made 8%. And if you bought it when the stock was trading upside down, you would have lost money. This is the arbitrage we saw before. This is not what we are going to talk about now. We are going to go into a live convertible preferred coming up. And I want to warn you one more time, I'm not endorsing that you buy or sell anything. I'm not a broker dealer. I'm not an investment professional. My goal is to educate you. All right. Having said that, we're going to look at Beckton Dickinson, BDX. Here is BDX. And the day we're going to focus on is May 20th, 2020. Remember, this is the depth of COVID. The folks at Beckton Dickinson said, oh my God, everything is shut down. Even hospitals are shut down. What are we going to do? And management said, maybe we should create a preferred stock so we can raise some money. We'll pay a nice interest, but we need to buffer up our cash flow. And I'm only focusing on the equity now. As you can see, the equity went up. Maybe people thought, oh, yeah, COVID has these needles and people are, there are going to be all kinds of needle sales. Well, that's not true. Needles are supplied by somebody else. And here's what it is. Oh, there is a recession. There is no recession. The stock kind of keeps bouncing from anywhere from 220 to 270, somewhere in that range. And right now it is at 237. And that's kind of how the equity itself is behaving. But if you rewind back to May 20th, 2020, they announced an IPO on June 1st, 2020, saying for the next 3 years, we're going to issue a preferred, which will trade at a par value of 50. The coupon is 6%. And you can see what happened. The day it came out and soon thereafter, that preferred traded significantly above par value. If you want to take a moment and guess why a preferred would trade so much higher than par value, go ahead. Ding ding, here is what you need to think through. Interest rates in July of 2020 were 0.2%. Since the federal funds rate was so low, a bond that pays you 6% was worth a lot of money, and that is why people were willing to pay 60 cents $60 for a $50 preferred that paid a 6% coupon. But what happened over the next couple of years? The risk-free rate kept going up, 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 and therefore the value of the preferred is going down, down, down. And this matures in 77 days. It is trading below par as of March 16th. And you can't just make a decision based on the preferred price in isolation or the equity in isolation. You need to put them one on top of the other. Here is what that teaches us. When the equity trades below the lower bound, then people are willing to pay a premium for the preferred because the preference is very attractive. When the equity trades above the upper bound, nobody wants to pay a lot of money for the preferred because the conversion or the preference is lower. Let's see where it is right now. Something interesting is happening. Right now, it is trading just below the lower bound. It is trading at the twilight zone. And you may remember the price of the preferred is $49 as of March 16th. So let's do some math. It was issued on June 2020, matures on June 2023. The lower bound is 240, upper bound is 280. In that area, it's pro rata. If you go above 280, the preference decreases. And if you go below 240, the preference increases. And right now, you have a very attractive preference. So what does that mean? Let's talk about the arbitrage. We're going to go buy one preferred stock for $49. and see what happens. Since BDX trades at 237 and the preference is 0.2, the effective price of BDXB is $49.36. That is 237 multiplied by 0.2. You can buy that for $49. So in theory, you gain 36 cents because you paid 49 for something that costs 49.36, and you also get a coupon of 75 cents. Why do you get a coupon of 75 cents? 6% of $50 is $3. It's paid once a quarter, 75, 75, 75, 75 cents. The last payment is due on June 1st and it converts on June 1st. So if you paid 49 bucks and the stock were to ride exactly at 237 on June 1st, you would make 36 cents plus 75 cents. If, however, the stock went up by 3 bucks, just 3 bucks, then the stock would convert, the preferred would convert at a par value, which is $50. So you would make $1 on that conversion because you paid $49 for something that is worth 50, and you would make the 75-cent coupon. You sit here and say, this gravy train is never going to stop. Maybe it'll go to 300 and I'll make even more money. And that is where you are wrong. When the stock crosses the upper bound of 280 and goes to 281, the preference actually drops. At a lower preference, it actually converts to a number lower than $49. So when you are in the twilight zone just above the upper threshold, you actually will lose a little bit, but in all likelihood, the price of the preferred stock would have gone up because, right now the preferred is at $49 when the equity is at 237, so you'll still come out kind of sort of ahead. But here is the killer. If the preferred drops by 10%, then you stand to lose a ton of money. Then you would really lose $3 plus on the par value. You will get the 75-cent coupon, but not much else is going to happen. So these are dollars and cents. Let's convert that into yield to maturity. And I'm again going to ask you to stop and think. Assume that you paid $49 for a security. The preference is 0.20, which means effectively you got $49.36 worth of something for which you paid $49, and somebody gave you 75 cents. So it's really $1.11, which is 50.11 minus 49. You made $1.11 in the next 77 days. What do you think the yield to maturity is? If you said a dollar for $50 is kind of like 2%, because if this was $100, I'd have made $2. So the yield to maturity is 2%. You will be wrong because the duration is only 77 days or 0.2 years. If somebody said, give me $49 today, 77 days later, I will give you $50.11, give it to them as long as you think they will give it back to you, because that is a yield to maturity of 11.2%. So if Beckton Dickinson trades exactly at 237 for the next 77 days, your 49 will work for you at 11.2% yield. What if it actually crosses the threshold and trades above 240? A couple of additional things happen. Not only does your 75-cent coupon come to you, the 49 now becomes 50. So you make $1.75 on $49 in 77 days. Get ready. That is 18.09%. Let's take another case. Let's say it crosses the 280 and goes into that twilight zone on the upper bound. Now you got a problem. In this case, the preference is lower, and instead of making stellar returns, you're going to make 5.23%. Still pretty good, but this is not all upside. What if BDX crashes? If it crashes by 10%, you will lose your pants and you are going to go to negative 12.6%. So at the end of the day, this is going to behave like an option. What I mean by that is there will be volatility around maturity. If it goes up a little bit, if it stays, if it goes up a lot, you win. If it goes down, then you will come down crashing and burning. You cannot just look at the price of the equity or just the price of the preferred. You have to look at both of them. Neither you nor I control what the price is going to be. Do not think this means somehow this equity or the preferred is the best thing since sliced life. For the next couple of months, bank CDs that are covered by the FDIC are as good as treasuries and they offer excellent returns. Bank preferreds may not be what you want to do, but who am I to tell you? Other preferreds, you decide what you want to do. You may even want to wait longer and see what happens. You may want to add duration to your fixed income, but I would suggest you wait until the debt ceiling discussion kind of comes and goes. Get some dry powder, sit on cash, sit on treasury bills, and wait on your brokerage login until the yield and the debt ceiling discussions come to play. Thank you for listening to Yield Nerd. Any questions, I'm happy to answer. Have a lovely evening. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.